Hi, I'm Irene Ray, Associate Director with the Market Practice and Regulatory Policy team. I take care of our asset management community. And today I'm very pleased to be joined by Daniel Murray, CEO of EFG Asset Management Switzerland, Deputy CIO and Global Head of Research at EFG International. And there are also several more titles which you may wish to raise. Thank you very much for joining us today in Frankfurt, Daniel. Yesterday, you participated in a very active discussion on mobilizing savings and investment in Europe, the challenges, the barriers, the difficulty of a customer journey, the geopolitical shifts recently that also impact the debate. What were your key takeaways?
Well, first of all, thank you, Irene, for having me at the conference and also for interviewing me. It's great to be here. I think for me, it's a super interesting debate. I think first takeaway is that there's a need to increase retail interest in capital markets, particularly across Europe. So I think that's a starting point. I think that having been said, there's a number of ways that you can do this. So one way is to incentivize via taxation, and that's a sort of a fairly direct route. I think another channel would be via the routes of regulation and deregulation, and also I think regulatory harmony and coordination across European countries. Because of course, if one country has different standards and regulations than other countries, then you may get regulatory arbitrage and it may be more confusing. I think a really important dimension relates to education, because of course, if people are ignorant or perhaps they just don't do something because their parents haven't done it, or it's culturally not something that they're aware of or that's done within their society, then it creates a natural barrier to participating in capital markets. So I think it would be super helpful to encourage participation from retail investors, just to educate them more. And there's obviously lots of channels, whether it's using something that's AI-based or internet-based, or whether it's outreach programs, but I think that could be really helpful. So I think lots of different ways that we could encourage stronger retail investment. And I could add to that as well, perhaps there would be things like auto-enrollment in pensions that would also increase retail participation. So those, I would say, are the main points.
And how do we tackle the alarmist culture in the risk of investing and not actually addressing proportionally the risk of holding cash deposits, which erode over time due to inflation? Is that a good place to start as well?
Yeah.
That's the equal risk of not investing.
For sure. Look, I think this is what people get scared of. They see that markets go down sometimes. If you have a year like 2022 where you saw painful experiences in both bond and equity markets, that can be really terrifying for investors, particularly at the retail channel. And I think this relates back to what I was saying about education. Investors need to be educated about the benefits of diversification. So, of course, you don't just own one stock, you don't just own one bond, you don't just have exposure to one market or one sector. You try to diversify. Famously, it's the only free lunch in finance is diversification. So that's something that investors need to be educated about. And I think, secondly, investors need to be educated about not panicking. So, yes, you experience volatility. Yes, markets can go up and down, but over the long run, studies repeatedly show that it pays to be invested in markets. You may have short-term periods where you experience a bit of pain, but over time, it pays to have exposure. And those two lessons, I think, diversification and the benefits of long-term exposure, really important to get across to the retail market in Europe.
And from the geopolitical perspective, there's so much going on. So again, how can we increase our own competitiveness vis-a-vis the US?
But that's also a really important point, and it's something clearly, US investors are much more heavily involved in financial markets. They tend to be much more market savvy, and a part of the reason for that is that a lot of US individuals are exposed to US markets because of their 401k savings plans. So I think that's something that needs to become more embedded in European culture. It's just the practice that actually it's good to be exposed to equities, it's good to be exposed to financial markets, it's good to understand where you sit on the risk spectrum so you can balance those risks appropriately. And I think this relates back to all of what I identified earlier, but in particular that legislation, that sort of enforced enrollment and the opportunities to give people tax incentives to invest. So I think Europe's got a bit of a way to go there. So too far behind today, but lots of opportunity to catch up in the future.
And what are you personally working on right now? What's your biggest passion project in this space?
Look, I think there's always too much going on. Clearly, at the moment, the world is dominated. Markets are dominated by thoughts around the Trump administration, in particular, with a very, very heavy focus on tariffs. And I think the biggest challenge at the moment is that in the short term, we don't yet know what the steady state is going to be. And so markets are finding that very difficult to price. I think in the longer term, there's a number of different ways in which this is going to impact the world. One is that, we have probably seen a structural break in terms of the way the world works. So this post-World War II world of increased globalization, increased international cooperation and coordination, that has probably come to an end, and we're going to see that go into reverse. And as part of that, we're probably going to see the world try to diversify out of US dollars into other assets. At the moment, the challenge is other markets, including Europe, are not deep enough or big enough to be able to absorb that flow in one hit. So I think it's going to take many years, but over time, that's what you'd expect. And I think that's going to be part of this journey of European capital markets really coming to the fore, and markets in other parts of the world. So that's obviously, I think the impact of the Trump administration is not just going to be, 4 years and done. I think it's going to be probably, it's going to take 10 or 20 years to wash out.
We've got a really interesting journey ahead of us.
I think so, yeah.
Well, thank you very much for joining me today, Daniel. Thank you for joining us in Frankfurt. It's been a pleasure speaking to you and having you on our panel yesterday.
Thanks very much.
Thank you.